We've had a couple tough days, and now it looks like we might have a decent day. What do you do?
Well, this is certainly a relief to the market. There's been a lot of worry if the government was going to shut down again. It's not the only worry that the market has, though, and there's still the significant upcoming deadline of March 1st if the U.S. is going to implement tariffs against China. There's still the fact that the global economy is slowing. The U.S. is joining that slowdown as well. So this is one piece of a very big puzzle.
We just had a guest on literally in the last hour who had made a call in December. It was probably the wrong call then, but he's holding with it sounds like, which is he wants you in cash, or at least overweight more in cash, because he thinks there's a decent possibility that we test the lows all over again.
There is a minority group out there that thinks so. However, some of the very extreme oversold conditions that you saw in December of this year have been ameliorated at this point. The second piece that you wouldn't want to be sitting in cash at this time also is because there has not been a tremendous amount of buying as a result of the 15% rally that you've seen off of the December 24th lows in the S&P 500. So there's still a lot of cash on the sidelines. A number of our sentiment surveys that we look at tell us that, but those were very oversold extreme conditions that you had in December that are unlikely to materialize again.
Okay, so what are you doing?
We are still positioned in our portfolios to have a pro-risk bias. It is less so than we have had in previous years. And we are barbelling our portfolios to the regions of the world that we have the most visibility on, which is the U.S. and in the emerging markets. And
in terms of China and this overhang of the trade issue, I mean, Brexit's an overhang. There's a lot of overhangs, but let's talk China specifically. What is your gamble? What do you think is baked in, as we were talking about in the last hour?
I think the administration certainly has seen the effects of a potential raising tariffs on China. It would be far less benign than they probably thought it would have been maybe a year ago. And I think that but this is likely to be an issue that the markets are going to have to contend with, not this year, not next year, but probably for the next decade. But it's a matter of, can we get to a point where we're not going to cross that very big red line of implementing yet another round of tariffs right now. It seems as though China wants to come to the table. They want to have a deal. The U.S. would likely like to have a deal as well, because, again, a lot of people are starting to think about the 2020 elections. Having a U.S. recession in front of the 2020 elections induced by putting tariffs on China would likely not be the best political move.